Welcome to New Money. I'm Bryan. This evening we are focusing on the investment world. Contrary to many who believe that the US markets would not perform in 2023, how wrong they were. Markets have continued to move ahead in the first 6 weeks of this year. Obviously, it's early days, and with half the world's population voting in their elections, there is no guarantee that there won't be a lot of volatility. Over and above this, and adding to this volatility, investors are waiting to hear more about when interest rates are likely to come down. Joining me this evening in the Zoom room from Cape Town is Henry Bilko, investment analyst at Anchor Capital. Henry, good evening. Lovely to have you on the show. Henry,
Hi, Bryan.
Henry, the last time we had you on the show, you were quite conservative. You were a bit worried about one or two things. We've now had a good start to 2023. How concerned are you now?
I would say I'm just as concerned as I was a month ago, Bryan. But what's happened since the markets continued to rally? If you look at rate expectations, they've come back a little bit, but the market's still expecting a number of cuts before the end of the year. And I just think that people are a little too optimistic at this point. I think it's a little bit too early to tell what a 4% plus federal funds rate means for the US economy and by extension the global economy. And like I said last time, I don't believe that you're being paid to take the risk in equities at this point.
Yeah. And Henry, what impact do you think the elections are going to have on the various markets?
I mean, it's difficult to say, right? There's so many geopolitical issues at the moment, and when you've got a polarizing character like Trump coming into play, I mean, just about anything could happen. And that's one of the reasons why I'm a little cautious on equities, because you don't know what you don't know. And I think given where volatility is at a very suppressed level today, given the valuations that we're seeing in equity markets today, I think we primed for an outsized reaction in the event that the unexpected happens.
Yeah, you mean the black swan events, we just don't know. Then, Henry, let me say to you, you spoke about interest rates, you spoke about, a couple of cuts, what the Federal Reserve at 4% interest rates will look like. But what is your best guess in terms of interest rates coming down? I mean, no one expected interest rates to come down in the January figure. I mean, the earliest that I saw was in March. But are you expecting that now to be delayed and interest rates only to come off later in the year?
Bryan, I don't want to hang my hat on what interest rates do and don't do. I think what I'm thinking is, what I'm wondering is, what will the impact of higher interest rates be on the actual economy on the ground? Because that ultimately is going to dictate what the Fed does. Inflation allowing, of course. Going back, just around 18 months now, the federal funds rate's gone, the cost of money has gone from basically nothing to 5%, so it's been a rapid ascent, and you're starting to see cracks appear. You're seeing the failure or the stress of regional banks in the US. You're seeing a real solid fallout in the commercial real estate space in the US, and I think that snowball will continue to gain momentum. And you don't know exactly how it will play out. But if the economy starts to falter, then the Fed will be forced to cut. But of course, if the economy starts to falter, the equity market will reflect that as well. And given where we are today, that won't be a good thing.
Henry, we just come through earnings seasons for the fourth quarter. Were you surprised or pleased with earnings? And what impact did the high interest rates have on many companies? Because you make the points is that, 18 months ago we had very low interest rates. Now are those interest rates now, the high interest rates now, factored in corporate earnings, certainly for 2023?
Yeah, look, I think there's an index composition issue at play here as well. We've spoken about the Mag 7 already. Those stocks effectively are really unimpacted by where interest rates are today, and their earnings have been fantastic. They've surprised to the upside, and you've seen those stocks reflect that, and that's had an outsized impact on an index like the S&P 500. However, if you lift the duvet, there's a lot of action underneath, and we're starting to see sector-specific stress appear. I've given regional banks and the commercial real estate sector as two examples, but yes, interest rates are starting to have an impact there. Where we haven't seen it perhaps have a tangible impact as far as corporate earnings goes on the US consumer. But again, we're seeing early stage signs that do concern us. For example, higher auto loan delinquencies, higher credit card debt delinquencies.
Kerry, So do you think there's just too much euphoria when investing, particularly what is commonly called, and so many people are now hearing the new term, the Magnificent Seven, and I'm not referring to Steve McQueen and Charles Bronson. I don't even know, Henry, I don't even know if you're old enough to ever even remember the Magnificent Seven. But is there just too much euphoria around about? Because if you think about the S&P 500, I mean, without those 7 shares, I mean, the 493 would have done very little compared to the 7 that have performed so well.
Yeah. Look, that's the great debate going on at the moment. You know, have we reached kind of peak euphoria? I can't answer you. What I can tell you is that compared to a year ago, there's a hang of a lot more optimism in the system. I mean, let's use NVIDIA as the kind of bellwether stock. I was looking at the earnings forecasts for that business over the next 3 years and what they've done over the last 12 months. Now, if we go back a year and compare what analysts were expecting versus today, those figures have gone up 3 to 4 times actually over the last 12 months. And that earnings outlook can change fairly quickly, depending on what your view on the economy is. So it concerns me that a soft landing is fully priced at the moment. And to the extent that that picture starts to worsen, the equity market will need to reprice downward to reflect that.
So let's talk about South Africa, because, you know, we all talk about offshore and what's happening offshore. And, you know, I've always been a very firm believer that if you're looking for growth, be offshore. If you're looking for income, stay in South Africa. But do you see much opportunity investing in the South African market? And if so, what sectors are you concentrating on?
Yes, there's no doubt about it. There have been net outflows from the South African equity market and, in fact, the South African bond market for some time now. And does our equity market look attractive? Well, from a valuation perspective, yes, it does. You know, the banks look cheap, the retailers look cheap, but things need to change. There needs to be some kind of catalyst for investors to come back into our market. That catalyst could be the end of load shedding towards the back end of this year. You know, that's a great tailwind for the retailers, for example. If there's a reasonable outcome in the election, and the outlook for the fiscus improves somewhat from what I would say is a very low base level over the next 3 to 4 years, then that could also be a tailwind for flows. So in the event that we get the right catalysts, we could have a good year in South African equities, yes.
It's quite interesting to say, because if the election goes well, and we're not talking about the election itself, but depending on what parties get in or don't get in, or what the ANC's majority is, I mean, you know, we've never been here, so it is an unknown number. But Henry, let's just talk about, because we've seen a big downturn in the Chinese market, down over 40%. Do you think one should be considering a small exposure to this market?
Yeah, so we've been adding cautiously to our Chinese positions, or our China positions at least. And any time when a market is down more than 50% from its peak, and that's exactly where we are now, you know, you should at least start scratching around for opportunities. It's not to say that there aren't very serious structural issues in China. There are. There's almost a semi-controlled but also semi-uncontrolled deleveraging taking place in that country. And there are structural or systemic issues at play. So the equity market should be taking pain, and it is. But is China a country with the capacity to turn things around gradually over the next kind of decade? Yes. Have we reached the bottom? I don't know, but we probably are close. So I think you can start to add cautiously, particularly given the outperformance that we've seen from America on a relative basis. You'd probably want to be lessening your exposure to the US at this point, and you want to start to add to your China exposure.
Yeah. So, Henry, when you mentioned earlier on that investors have exited South Africa, I mean, we haven't seen the rand improve at all. It's still around the 19 mark. It has dropped to 18.50 at 19.25. Is that because money's been leaving our markets?
Yeah, absolutely. I mean, no matter which part of the market you look at, whether it's bonds, whether it's equities, I mean, we've had meaningful outflows over the last kind of 12 months, and that's kind of reflective of where we are in the cycle as well. You know, in a market like the US increases its rates like it has in such a short space of time, and there's going to be an unwind of the carry trade, so to speak, which is bullish for the dollar and bearish for the rand. So over the kind of medium term, do I see the potential for a stronger rand? Absolutely.
Henry, what about the America and Britain, because of our stance in terms of who we've made friends with? Do you think there's going to be big punishments? Do you think we're going to be affected by AGOA and things like that?
Yeah, of course. I mean, people have been speaking about AGOA for the longest time now. It's something that is beneficial to our country, to our economy, and we keep on putting the terms of that agreement at risk. And if the US do end up terminating, well, it'll only be to our detriment.
Will we not be given maybe support from other markets to make up for what we lose on the US side?
Yeah, perhaps. But I mean, again, it's an incrementally negative development. But look, again, probably what you should be looking at is what's happening in China, right? That's going to have the most pronounced, the most significant impact on what happens with our economy. If China does well, we tend to do better. If they do badly, we tend to do worse.
Yeah. Henry, behind your head is a little crystal ball. So my next question relates to the crystal ball. Do you think the US is going to avoid a recession? And if not, how severe do you expect it to be?
So I don't think they'll avoid one. No, I don't think you can defy gravity. Look, I think it's probably going to be worse than the market is implying at this stage. I think that's my kind of stance. You know, so again, you and I always go back to a balanced portfolio and back to one's long-term asset allocation plan. So with that kind of context, would I be overweight, neutral, or underweight US equities right now? Or in fact, global equities, I'd probably be underweight.
Well, I'm going to give you a moment to breathe as we take a short break. Stay tuned. We'll be back shortly.